Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So over the last few months, the S&P 500 has not done well at all. In fact, it's flat since the beginning of the year, which means basically it hasn't gone up a lot. About a couple of weeks ago is actually down about 7%. And over the last few weeks, what I've been doing is basically researching on different sectors within the S&P 500. In fact, the last couple of days, to see what sectors have done well and what sectors that have not performed well. And my plan is, inshallah, starting today, is to look at each one of the sectors that have not done well and identify companies that are high quality businesses that are still undervalued that we could potentially add to our portfolios. Because what you don't see in the basically in the news and everything else is basically each sector has some high quality companies that nobody talks about, and some of these companies are the ones that are still down. Now within technology, for example, companies like Nvidia and so on, or even semiconductors, even the semiconductor ETF has now recovered from basically being down at the beginning of the year. So those companies are high flying companies, but the rest of the S&P 500, there has a lot of companies that are still down. And it's my job in the next few weeks to actually identify some of these basically companies that are down, that are still high quality businesses. And what you see here is the performance of the S&P 500 sectors in all 11 sectors for a year to date. And as you can see, some of them are in the green and done really well. So basically communication services, which includes Meta, which includes Google and so on, is doing really well. You got consumer staples, because when the stock market was down a lot, the consumer staples were doing well. So companies like Procter & Gamble, companies like Colgate and so on has done okay. Now financials have done well, so all the banks and so on. Industrials are up almost to 10%, which is really interesting to see. And then you've got materials is up, real estate is up, technology just recovered, and as you can see, utilities are also up another 9%. But consumer discretionary, energy, and healthcare has not done well. And out of the three, I'm going to go over some of the companies that are in the healthcare today. So I'm going to give you 5 companies that I feel like are undervalued in the healthcare sectors right now. And inshallah, I'll share that with you guys. And then next we'll probably look at consumer discretionary, maybe the energy after that, and then we will work basically we will do a research on every single one of these sectors in the next few weeks, inshallah. And the reason I'm doing this is just not to, of course, give you a financial advice or anything like that, but just to kind of identify some of the companies that are right now undervalued, that people are not talking about, that you could potentially buy while they're still cheap and hold them for a very long time in your portfolios. And that's my goal, inshallah. Now, if you haven't joined us at the Patreon account, please do so. You can actually get access to a lot of things, including the family portfolio. I've just done a family portfolio update. I've actually added 2 new companies to that portfolio. I've actually sold one, so I've shared that with the community just this afternoon. So if you are interested, join us in there. And of course, it does help basically to support the channel. So let's get started with the 5 companies that we came here for. And what I'm going to do now is just to kind of give you overview of each one of the companies, but please do your own research. So all of these companies have a wide moat. Again, remember, they're all healthcare companies. They have been paying dividend for quite some time. Some of them, their profit margin, return on equity, return on invested capital is something that we normally look at because it gives us an idea of how effective the management is. If the company is profitable, we want to see if they have a free cash flow. So if they pay dividends, we want to make sure the company is actually, has enough cash to cover that dividends, because you don't want a company that's buying, paying you dividends, but they're borrowing from the bank and so on. And also we want to see where the company is going in the next basically year. So is the EPS, earnings per share, is it growing? Basically, from where we are right now, how much are they expecting to the EPS to grow? How much are they expecting the revenue to grow? Because between these two things, these are the 2 most important things when you look at a company. If they have a growing earnings, growing revenue, that's what you want to see year in year out. And of course, then if the company has reduced their costs and they're more efficient, that's basically where these things come in. And we want to see a Morningstar valuation, how undervalued or overvalued these companies are. Like I said, some of these companies are just undervalued. Some of them are fairly valued right now. So let's have a look at the first company, and that is Merck. This is a company that I've had in my portfolio for over 5 years now, and is right now I think it's about 4 or 5 years. 191 billion. It has a white mode, $77 per share right now. The dividend yield is right now is over 4%, which is interesting. The payout, I think this is the highest it's been since I've owned the stock. The payout ratio is 40%. The latest increase was 5%. The 5-year growth rate of 7%. 13 years of increase in that dividend. You get $3.24 for every share of this company that you own. Dividend safety 90%. The highest you can get is 99%. Profit margin, return on equity, return on invested capital, probably one of the best out there. $17 billion of free cash flow right now. EPS is about 17%. Revenue and basically is 1% growth expected next year. Morningstar is expecting about 43% upside from where we are. It's $111 per share is where they think the price should be. And as you can see, a year to date, the stock is down about almost to 22%, and for the 1 year, it's down 40%. The lowest of the 52-week low has been $73 per share. It is very close to that right now. And if you look at the Seeking Alpha analyst to basically Wall Street, what they're saying is a 12 strong buys, 13 basically buys, 11 holds, no sales whatsoever, and there's about 31% upside from where we are. $102 per share is where they think the price should be. Now, the next company I want to share with you guys today is Thermo Scientific, another healthcare company. Like I said at the beginning, all of them are in the healthcare. It has a white mode as well. It's a huge company, $153 billion. Now, the dividend yield is very, very low, but the payout ratio is basically low, so which means they can increase that dividend every year, and they are actually doing that. 10% basically latest increase, 5-year growth rate of 16%, the dividend basically streak of 7 years, so they've increased that for 7 years. Annually, you get $1.72. Dividend safety or 72%. Profit margin, return on equity, return on invested capital is decent. Free cash flow closer to $7 billion. They're expecting the earnings to grow about 3%, revenue to grow about 2%. Maybe that's why the stock's done a lot. $630 is where they think the price should be. Right now is only $410 per share. And looking at Seeking Alpha, as you can see here, is about 21% down for year to date, and the 30% basically down for the 1 year. 52-week low was $390 per share, not far off from where we are right now. And Wall Street is actually saying 18 strong buys, 7 buys, 8 holds and 6 holds, and no basically sales whatsoever. And $570 per share is where they think the price should be. And right now we're looking at about 38% upside from where we are, which is very interesting again. Next one in J&J. J&J is one of the companies that I've had in my portfolio for quite some time. I've sold it because of the lawsuit that's going on. They currently have an upside of about 7%, which is interesting because that's where it has been hovering around for quite some time. $153 per share, over 3.5% dividend yield, 50% in terms of basically payout ratio. Latest increase was 5%. The growth rate for the last 5 years, we're looking at about compound annual growth rate of about 6%. 62 years of increase in that dividend. So that means, everything that has happened over the last 62 years, this company was increasing that dividend. And this is why I actually genuinely love dividend companies that have increased their dividend. The aristocrats, the kings, and so on, increasing it year after year, no matter what has happened, whether we had a recession or stock market was down and whatever was happening, they were increasing their dividend. So $5.20 is where you get 99% safety. Profit margin, return on equity, return on invested capital, probably one of the best out there. $20 billion of free cash flow. Earnings they're expecting to grow about 6%, revenue about 3%. Like I said, Morningstar is basically saying it's 7% upside from where we are right now. Funny enough, this is the one of the ones that's still up. So 6% up for year to date. For the 1 year, it's almost about 2%. Looking at Wall Street, they're saying about 7 buys, 4 buys and 7 strong buys, 4 buys, 13 holds. And if you look at this, it's about 10% upside from where we are. Now, the next company we're looking at today is AbbVie. AbbVie is a spin-off of the AbbVie Laboratories, 321 billion market cap, so it's a huge company. Dividend yield of 3.6, which is one of the highest here. We've got payout ratio 62%, slightly higher than I would have liked. Latest increase was 6%, the 5-year growth rate 8%, 53 years of increase in that dividend. So they are dividend king because they inherited it from AbbVie Laboratories. Annually, you'll get $6.56 cents. Dividend safety of 80%. Profit margin, return on equity, is return on invested capital, all fine. Free cash flow, $17.8 billion of free cash flow. Check all of these companies are excellent free cash flow, and that's what I love to see in terms of expected. And expectation is moving forward for EPS is about 21%, revenue is about 6%. Right now it's flat because $184 per share is where they think the price should be. Right now it's $184 per share. So I will say it's a fairly valued right now according to Morningstar. A year to date we're looking at about 4% up, and basically for the 1 year about 12% up, which is quite nice to see. Wall Street is saying 12%, basically 12 strong buys, 4 buys, 12 holds. And if you look at this, is about 14% upside from where we are. $210 per share is where they think the price should be. And the final company today is Gilead Sciences, 125 billion market cap. It has a wide mode. Every single one of these companies has a wide mode. $108 per share, over 3% dividend yield. Payout ratio only 40%. Latest increase was slightly disappointing, about 3%. The 5-year growth rate only 4%. I would like this to be about 6 or higher, which is what I'm normally looking for. Dividend streak about 9%, basically years of increase in that dividend, and then annually you'll get $3.16, 17 basically %, when it comes to safety side of things. Profit margin, return on equity, return on invested capital, again really good. $9.6 billion of free cash flow. They're expecting the earnings to grow about 73%. Revenue is flat this year, and also right now is $108 per share is where they think the price should be. Right now is $108 per share. Now that is the basically the 5 companies I wanted to share with you guys today. So quickly looking at Gilead and Sciences in Seeking Alpha, as you can see, Quant is saying is actually strong buy. Wall Street is saying is a buy. A year to date is actually 17, almost 18% up. 1 year 60% up for 1 year. So the highest it's been is $119 per share. It's closer to the all-time highs than actually the lowest, but it still seems undervalued, or still seems fairly valued right now, which is interesting. I might actually have to do a bit more research on this one because it seems very interesting from growth perspective, as well as, in fact, I'll share that with you guys in a second. We've got strong buys here about of 15, which is fine, and then 4 buys and 11 holds. That's why it's not strong buy. And we've got about 6% upside from where we are. $115 per share is where they think price should be. Now if we look at the earnings expectations for this company moving forward, that's where the 72 came from. Then 6%, 9%. So there must be something going on. They must be done some sort of they must have acquired another business recently. That's probably why the EPS has grown up so much. We'll check that. Maybe we need to do a little bit more research. And revenue is basically is flat here. 3% after that, almost a 4%, another 5%, 4%, and so on. So in terms of Sharia compliance side of things, again, you can post the video. This comes from Zoya. Basically, this is standards that they use. Again, I have no affiliation or anything like that. So if you want to sign up for them, that's entirely up to you. But that's what I use normally to get my information. And of course, there are other platforms that you can use. So that's the 5 companies I wanted to share with you guys. What I'm going to continue doing is in the next few weeks, inshallah, look at the consumer discretionaries. We're going to look at the energies. Then we're going to look at the rest of basically companies, especially technology as well, because that's the next one. That's actually after the red ones. That's the next one that's flat almost for the year. So it'll be interesting to see what companies are in the tech company, because we need to have a diversified portfolio, because that's what I'm trying to build here, and to basically try to build a diversified portfolio. So when Broadcom is doing great, then fine, the rest of them might not be doing but well. So if the tech is doing well, I know basically I'm okay. If consumer discretion is doing well, I know I'll be fine, because I've got companies like Home Depot and so on. If financials are doing, I've got MasterCard and Visa. You're gonna have to have that sort of a diversified portfolio, inshallah, moving forward. One of the companies that I really like, that I feel like is really undervalued, is this one here. This is not in the S&P 500, but it's one of the companies basically that is undervalued a lot right now. So I've got basically, I think it was £160 in here. So I'm going to buy 1 share of this company. I've been doing that for the last few weeks. I'm going to continue doing this, inshallah. I just want to share with you guys, I'm still basically net buyer when it comes to stocks. So I'm going to always continue to add in basically this type of companies to my portfolio. And the next one is actually also another healthcare. So whatever is left of that money, I'm gonna buy, there we go, 1.8 shares of Merck as well. These 2 companies are undervalued in my opinion. I'm going to continue adding to them as long as I get the chance to add to them, inshallah. So I've got 61, basically almost 62 shares of Merck right now, and the other one I think I've got about 80 something shares if I can find it, that is. Okay, I've got about 83 shares of this company, so I'm gonna get to 100 on this one. If I can get to 100 on Merck as well, that would be absolutely amazing. Then I can just let them be and let's see what happens, inshallah. So yeah, I'm gonna continue buying in these high quality companies, inshallah. As always, don't worry too much about the fluctuation of the prices of the stocks and things like that. Focus on your long-term goals and whatever you need to do. And again, if you're a dividend investor, collect that money, reinvest it, and then let it be, inshallah. Anyway, have a wonderful day. Assalamu Alaikum.